Hey, small business owners, are you looking for alternative sources of financing because the bank interest rates are super high right now? Well, that's what we're going to be talking about today. We have Jack Chang, who is the managing director of DGP Capital, which is an investment bank, with us today to talk about alternate sources of financing, which is a hot topic right now. So we're excited to do that. I'm Corey Harlott, creator of Key Hire. And if you're watching us on the live stream or you're checking us out on our YouTube channel, Key Hire Solutions, or you're listening to us on the podcast, be sure to hit the like or follow or subscribe button. We post this content twice a month. Want to make sure you don't miss out on that. We'd love to have you be a follower and support the program. What has happened lately? I still need to talk to Matt about our music a little bit. Matt, bug in your ear. We need to get something a little more rock and roll. I think I got the guitars in the back. People keep asking me about them. But today with interest rates, inflation, it's hard to move things. And I know a lot of business owners are going to the banks and they're making them jump through hoops. They're making it really difficult on them. They're charging insane rates, and people are looking for alternative ways to fund or cover debt or get loans for their businesses. And I just happen to know a guy who knows a lot about this stuff. In fact, with his business, DGP is really big. They do a ton of selling. They help small businesses, small to mid-market businesses sell. They do some acquisition work as well, but this has become a hot topic. Jack and I were talking about this a few weeks ago, and I thought, hey, we should really bring this to light and have a conversation about it, because I'm sure there are people out there who would love to know about this alternate resource if they don't already, or how it works. Maybe there's some questions around that we can clarify for them. So Matt, let's bring Jack on if we can. Hey Jack, how you doing?
Hey everyone, how you doing?
Hey, was I close with my description?
You were. You did a great job. Thank you.
Awesome. You get into this private equity investment banking world. It's so nuanced, right? Your business, and I think I was right, we kind of overlap in terms of what we do. I know Key Hire works with businesses that are like $5 to $25 million in revenue. I know, and you have a very specific niche. You have kind of three markets you cover. So what size businesses do you work with, and what are those niches you work in?
Yeah, well, we typically transact with clients that are at least 10 million in revenue. I'd say average deal size from revenue perspective in the last 12 months has been about 40-ish million top line revenue. The three core industries we cover are industrials, manufacturing, B2B services where there's a blue collar or field service footprint, and last but not least, energy with an asterisk on it. On the energy side, we're really not going to be the team that covers upstream. We don't have Aries. We don't have an upstream engineering team. We don't have a balance sheet to lend to. So we don't really focus on the upstream side. Downstream, midstream, and OFS, we certainly would look at it. But I would say a bulk of our deal flow is really on the industrials and manufacturing space. Cool. And we're not geographically bounded either. We've done deals on the West Coast, Central U.S., East Coast, all across. We're within a 4-hour flight from anyone. Our team's able to rapidly deploy as a result of that.
Yeah, you're saying you're headed out of state. Is it this week or next week or something?
Oh yeah. Next week we've got an engagement we're going to work with a client on, and that's another thing that we do. We'll parachute in. We'll work direct with our clients. We'll do a lot of hand holding that other investment banks may not do, and the reason why is it's not every day that business owner or the CEO or CFO is doing M&A or is looking at refinancing or recapitalizing the balance sheet. So what we do for a living, and they have a business to run, they have day-to-day operations to deal with. They don't have time to mess with it. And so a lot of times that's what we do. We do a lot of that heavy hand holding. That's certainly a value add and something we enjoy doing because at the end of the day, all of our clients, for the most part, are private business owners. Right. We very rarely represent private equity backed or strategics, but every once in a while we do. But I would say vast majority of business is from private business owners.
Okay, cool. And I know that we're talking about kind of that alternate funding or debt coverage and all that good stuff. And this conversation came We belong to the same Vistage group, and
Right.
just did some work with Chuck. We did some webinars and things. So shout out to Vistage and Chuck. But you were talking about the business has shifted lately into this kind of alternate financing world, and I thought that's really cool. So let's. The first question is, what is it? What is this alternate financing, or how can you help someone, or why is it a good idea for someone to look at this?
Right. And I'll preface it with, it's not always a good idea. There are very specific rationale and reasons for it, but that in a low interest rate environment, that used to be much more narrow in terms of where, alternate debt solutions could come into play. But before I even go there, I'll describe briefly what we mean by alternate capital solutions. Let's say you're an owner of a $20 million business. You don't have a ton of debt on the balance sheet. You've had some rocky years in the last couple of years, but you got great backlog, got EBITDA positive, you've got good workforce and good customer contracts. Now you're going out to the large commercial banks of the world that you thought you had a relationship with, and you're presenting your need to have a working capital line or revolver or some type of term debt. And now you're being told no. Well, it's not that your business isn't there. I think 12 months ago, you probably could have gotten that debt, assuming the financial metrics are there. But right now, as it is, most commercial banks are being much more restrictive in terms of who they lend to. And it's not because they don't have the capital. It's because they're more risk adverse given the current volatility in the debt capital market side. The fact of the matter is, in terms of leverage, right? We judge leverage in terms of how much debt can someone place as a multiple of your EBITDA, which is your earnings before, interest, taxes, and depreciation, amortization. That's the industry parlance is leverage ratio. If you looked back maybe 12 months ago, some banks do 4 times leverage, some do a little bit north of 3. And maybe 6 months ago, I spoke to most of our commercial banking colleagues, and they're saying, well, our credit committees are telling us we got to stay under 3 times leverage. So, for example, if you're running a $20 million business, $2 million EBITDA, what does that mean in terms of total debt capacity? Well, you should be able to do $6 billion in debt. Now we're being told by most commercial banks that number is even going down below 3. So as a business owner, you're not getting as much leverage capability out of your traditional financing and your traditional corporate and commercial debt providers out there. So what are you going to do? You're not getting the financing you need. What the industry does offer, and this is outside the regulated commercial banking realm, there are a ton of private lenders out there. Most of them are private equity firms or private equity linked. Some are even backed by the SBA through a special, small business investment corporation, or an SBIC as we call it. All these are different types of lenders that are non-bank that, number one, are going to have a little bit more flexibility on the coverage ratio. They're going to have possibly more flexible payment structures. And number 3, more potential flexibility amortization, which is the rate at which the principal balance of your loan is paid off. Commercial banks don't have that flexibility. They got to get their interest and amortization straight line. I mean, that's just how it is. Not many of them will have that flexibility. So that's where private lending comes into play in an environment like this.
And just to go back, you talked about, the multiple is lowering, but are the interest rates are going up from the bank as well? Like, where have they gone
correct.
as well?
Well, the spreads, most commercial debt is priced on SOFR, which is the overnight funds rate, or as a result of prime plus some percentage as a margin. Some are priced on senior debt. Some used to be priced at SOFR or prime plus, call it anywhere from, on the very low end, 3, on the very top end, for senior debt, 6. When you go to sub debt, which is you don't have as much asset collateral coverage, and on the capital stack, you're behind senior lenders, it can go into the double digit plus prime. So what does that mean from a total overall cost of capital on a debt lending standpoint? Well, when times are good and when times are great, when interest rates are really low on prime, all in, you're probably paying, mid single digits, on your total debt. Now most borrowers are paying, because of that floating rate, they're paying probably 9+%, some even low double digits on their debt. And so fast forward a year from now, when private lenders were traditionally seen as too expensive, now they're actually kind of competitive from a rate standpoint. They're probably not going to be that far off from your standard commercial lender, maybe 100 bips more, maybe 200 bips more, depending on the tenure of the loan, depending on whether or not it's senior or sub, et cetera. But they can start to be competitive now on a pricing standpoint. That pricing valuation gap on cost of debt, the interest rate you're paying, is actually narrowing. And on top of that, they're going to give you a lot more flexibility than a traditional bank lender will.
So they can be more creative. So now that
Absolutely.
gap is closed, tell me if I'm getting this right, because I'm learning as we go here.
Sure.
Because interest rates are high, the private institutions are more attractive because the gap is closed between rates, but the private lenders can offer more and different flexibility than a big bank can.
Absolutely, they can.
So now that they're close, the advantage might be kind of shifting a bit here if you have to do it.
Right, if you have to do it.
Lender, because they can be more creative.
That's right. It's all about their creativity and their risk tolerance. That does come with obviously a cost. They're not going to be as cheap as your traditional senior lending. But now that the price parity has dropped a bit because of rising interest rates across the board for traditional lenders, a lot of these private lenders, they've raised their capital from private pools of capital that they're using as their capital base to lend out their balance sheet. They raised it at much lower rates and lower expectation of return on yield. And so they can start to be competitive. Will they beat bank rates? Probably not. But you're talking about 100, maybe 2, max 300 bips up on the same type of lending. But at the same time, you're getting a lot more firepower. You're getting, you could get another turn on EBITDA on debt. So, going back to our example of 2 million EBITDA business, the max they may be getting an initial line from a commercial banker now might be 2 times of that. So that's 4 to 5 million in total debt on the balance sheet that a lender would be willing to initially step into on the standard commercial side, versus a non-bank private lender. They go up to 6 million 3 times. So you're getting 2 million extra in debt capacity. Does that come with a cost? Yes, certainly, but it comes with flexibility too on payment. And if your funding needs are such that you're very comfortable with your cash flow, and what you really need the money for is working capital to be able to do the work to secure the revenue that you've already got signed up, well, that's essentially what it's a good option for.
Right.
I'll give you another case in point. There's a client we have that a big issue for them is really hiring and retaining talent, right? Hiring the right people, and labor costs aren't going any lower, right? And Corey knows that better than anyone else at Key Hire. You got to pay these people. You got to pay them well, even especially when it's a really hard, arduous work as it is in a lot of field service industries. You got to staff up to be able to perform the work on your backlog. How can you do that if you're constrained on working capital and your bank's not going to give you the breathing room you need, right? We're not going to step up to the plate and lend to you because you're all of a sudden in an out of favor industry.
Right.
Private debt is probably the way to go because they're going to have a lot of flexibility on that. They'll get a little bit more comfortable with some customer concentration risk. Not all of it. If you got 100% customer concentration risk, well, not a lot of lenders for you. But if you have, say, one customer that's 20% of your revenue, some lenders will just say, "Oh no, can't do that." Commercial lenders at traditional banks, and then a private lender will look at that and say, "Yeah, it's okay. The rest of your revenue stack doesn't look that bad. Pretty well diversified. We can live with it." Or okay, you have some oil and gas clients. Not a lot, but some. We can live with that. Some commercial banks will see that and say, "Can't touch this," right?
Because they have rules in place. And
some it's ESG driven. Some it's also portfolio management. They've already lent to so many people already that have exposure, and there's a balancing act when it comes to managing a portfolio of loans.
The other side of that is getting that capital. Like you said, they need to ramp up, and I think one of the challenges they might face is if they do have large oil and gas clients or large capital C corporate clients, they go into that 90-day pay cycle.
Oh yeah.
And
absolutely.
then if the invoice is wrong, they got to resubmit it, and then they go back into the queue. So they're waiting. It's hard to ramp up.
Yep.
I'm waiting 90 plus days to get paid for work. Like, where do I get that extra cash to hire those extra people when on the balance sheet I have the money, right?
Yeah.
But it's not in the bank, and it's going to be in the bank. I just hope the invoice was done correctly, and it's, we're 60 days out.
Yeah.
And that's a repeating cycle. So that might be one of those instances you're talking about where we need
like
to
a
ramp.
revolver. Yeah, especially if you're high on AR, but you're still got good recoverable AR. It's just that maybe you got a couple of clients that are much larger and they're pushing around 60 days plus out on cash conversion cycle.
Okay.
A good AR line can help you out. Revolver will help you out on that. Private lenders do that too. I mean, they're not just all about term loans. They could do asset-based loans as well. It's based on real estate or revolvers. They love doing those, and they're pretty cost competitive relative to traditional bank lines as well. Different set of circumstances on covenants, and they'll also even look at situations where, let's say you're a business owner, you have other assets, and your banking relationship's not cutting it. They're not stepping up to the plate. Well, some of these lenders will certainly be able to give you a little bit firepower based on your off balance sheet items that a commercial bank might look at and say, oh, well, it's not tied to the business, I can't lend against it unless there's already a private wealth relationship associated with it. But some of the private lenders we know, they have a pretty good willingness to kind of jump into that pool and to be creative on how they cover their butt, so to speak, on asset coverage.
Cool. So here's another. I'm sure a lot of business owners overvalue their baby, right?
Yep. Yeah.
And so that's something you have to battle. But also, when I'm a business owner and I think, hey, this sounds kind of interesting. Jack, I know the checklist is about 1,500 items long about what you need to have to go to the bank or go to an investment bank, right? A private bank. What are kind of the top 3 things that you would say, like, if you want to do this, here are the 3 steps you have to take to at least get the ball rolling, to taken serious or get in the door or start the conversation.
Get your financials in order, number 1. So if you don't have strong financial reporting, it's in-house with the CFO or fractional CFO, or whether or not you have a third-party accounting team that comes in every quarter or every half year or year to do a reviewed set of financials, you're going to need that. Most banks, even private lenders, their requests will always be, do you have audited or reviewed financials? Even though I know you're running Sage or you're running some other ERP system, still want to see a third-party review it and kind of.
Auditing, I was going to ask you that. So what is it? What makes the financials solid like that? And it's having a third-party audit is key.
Yeah. If not an audit, at least a review. Because we know sometimes people look at the audit, the cost of an audit, like, why do we need it? I mean, I know for me, I know how my business runs. It's not about that, right? Audits sometimes make a ton of sense. And sometimes a set of reviewed financials is really sufficient. If you ask a bank or any lender, they prefer audited, but you can get away reviewed as long as it's not too messy. That's the key.
This is just to make sure you have what you say you have. And
correct. Your financial performance. Correct. Your financial performance is up to date. Number 2, have a good story to tell. Right.
Okay.
No business is perfect. No person is perfect. Maybe you had a bad year in 2019. I don't know. Maybe you had a crappy year in 2020. Maybe 2021 is an anomaly relative to everything else. Who knows? But you have to have a reason why. It has to be a valid reason. It can't be just, hey, well, stuff happens, right?
Right.
It's not a good enough answer. You have to have a cogent story as a management team and a business owner as to why performance may have been varied relative to expectation. And on top of that, how future performance is not going to necessarily be dictated by past performance. What evidence do you have as a business owner to make me as a lender believe that you're going to hit your numbers, right? If you're going to tell me this year business is going to jump up 25%, well, show me what's your backlog look like,
Right.
who are your customers list.
And I'm sure that's positive and negative, because I'm sure, like you
absolutely
2020 or 2021, some people had horrible years, but some people had record years, right? Now they think, oh, this is our new trajectory, so we start forecasting off that.
Right.
And now the market normalizes and they come back to earth. So you have to be able to explain that as well, I would imagine.
You do, and that's, you're absolutely right, Corey. There's a downside to having a really blowout 2021, 2022. For example, a lot of building products businesses and construction businesses that kind of catered to kind of that residential market did really well.
Sure.
Well,
not
so much. A lot of it was also driven by price increase on things in general, not necessarily volume. Mm-hmm. And so most private equity firms, acquirers, and also private funding sources and commercial banks are smart about that. They know that that's a big reason why revenues maybe went double or went at least 50% up on those boom years, and that's not really sustainable. If you think it's sustainable, you have to be able to prove it. What in your mind, in a lender's mind, regardless of whether or not they're a private lender or a commercial bank, they're going to think about in terms of how recurring is your revenue.
Right.
Is there something to make me believe that something's backstopping all this revenue, whether or not it's vendor agreements, whether or not it's supply agreements or long-term take or pay, which is pretty rare in general, but you get my drift. You have to have some kind of contractual stickiness to that revenue, or else it's just, it's what we think it is.
A million questions racing through my mind, and I'm looking at the clock thinking, okay, well, I'm going to get way off track on this. So we consider doing this again to talk about other things, because my next question is, how many people went out in 2020, 2021 when they're having these boom years when they didn't expect it and borrowed against their EBITDA and then came back to earth, and now they're in a little
ton of them. And it actually goes not just in private businesses, but also private public companies have the same fate. Private equity backed businesses are basically in that same boat too.
They would have bought on a high multiple, right?
High multiple. They got quite a high multiple. They probably did some really high leverage, plus 4 times on EBITDA, on leverage. So they're, pretty heavy balance sheet hit. And assets aren't priced any different than they were today versus yesterday. Right. Pretty similar on hard assets. So asset coverage is the same, but all of a sudden, if cash flow drops significantly, it could be a problem from your covenant standpoint, because you borrowed based on a projected EBITDA number. And if your EBITDA number is way below that, well, all of a sudden you're below covenant and you're technically in technical default with your lender, and that can cause a lot of sticky problems.
It's a problem.
Yeah.
Sure.
Statistically, I unfortunately don't have statistics on that, but I'll tell you, we've seen a lot of kind of alternative debt funding requests come across our plate from private companies across the board, because they're seeing the same pressure. Even if they weren't bought out, they certainly borrowed at certain points, and they're having a hard time fulfilling their work going forward because of working capital constraints. They don't have the cash flow to hire people, slow pay.
Yeah.
Now they're having to go out to the debt markets, and really the people that are really stepping in are really, for the most part, going to be your private lenders that could fill the gap of those kind of near bankable clients.
Okay. So switching gears, and we're running, I want to be aware of time here, but what would be the mistakes or the pitfalls people don't think about when they look at this kind of alternative funding?
Their existing debt on their balance sheet. Number one is, people a lot of times, their business owners in this scenario, they have existing debt on the balance sheet, whether or not it's a CARES Act loan or PPP that hasn't been extinguished, or USDA, whatever it is, whatever type of debt solution they currently have, it all goes together with your additional funding asks. And every single lender, regardless of whether or not it's commercial or it's private, will look at the entire debt request in that perspective. So for example, if you currently have $5 million in your balance sheet and you want another $5 million, they're not just underwriting $5 million as a new lender, they're underwriting 10, because they're thinking, well, am I first line position, first lien? Am I second lien? Do I have subordination? Do I have asset coverage? So the things that tick through their mind and thinking about, well, will I lend to this person? I know they can technically pay me back $5 million if things go default, but what are the lines in which I'd have to stand behind to get paid? Right. I worry about that. And so a lot of lenders will tell me, they're like, well, we're only underwriting 5 million, but technically we're thinking about it in terms of underwriting the whole 10, because we have to wait for that person that was in front in line of us to collect their 5 in the case of default before we ever get paid out.
Right.
That's one mistake a lot of borrowers don't really contemplate, is that, hey, you know what? It's all about whether or not someone can get paid back in a reasonable amount of time.
Right. That's interesting, and it makes me think of how these conversations can get a little sticky at times, because as the lender, you're like, $5 million is a lot of money, right? You want to make sure you get that back, and oftentimes the business owners are like, we have revenue, we're ticking along.
They're thinking
everything, and you're undervaluing it. And I think you might be undervaluing that, and you might be thinking, actually, we might have given you a little bump on that, and giving you a little more than we should have, or whatever it is. So it's what I'm hearing is, this isn't just like a gut feel thing, right? You guys are like digging into everything to make sure this is viable, that you can recoup.
Correct. Can recoup. And a big part of recouping is asset coverage. So a lot of lenders won't necessarily tell you that up front. They'll dig in your balance sheet and try to figure it out. But let's say you have a scenario where you owe a ton of money to a lender, right? In case of default, their first course of action is hoping that in a liquidation scenario, you have enough assets on your balance sheet, whether or not it's plant, equipment, real estate, to cover that debt, at least some percentage of it. The farther you get away from coverage and the more reliant you are on cash flow to fund that debt and pay it down, the more scary it gets for lenders. And especially for commercial lenders, they really will not. This is what we call an asset airball. They really won't look at it anymore if it's substantially above what they would like to see, which is 100% asset coverage.
Right. So that might be like a service company where their business is
all people
going out, and they don't have a product, so to speak, but they don't have a lot of assets.
Yes, that's correct.
Okay. So Jack, thank you. If I'm a small business owner and I'm thinking, this sounds like something I need to explore, what's the one thing they should take away from here today, that they should start looking into or researching, or what action could they take?
I think talking to, certainly speaking to an impartial third party that's not a lender is helpful, right? Whether or not it be a CFO in-house that they know, or if it's an intermediary like us that we're not a lender, we put people in touch with lenders. And so we're not biased in terms of, hey, we only want what's a good deal for us. Our goal for our clients is to help them with the best capital structure possible. And we'll look at your capital structure. We'll tell you, hey, is this viable or not? Or are you reaching? Or should you really think about, frankly, restructuring some of your company, because you're kind of way over your skis on debt, and we just see a endless treadmill in sight. A lender may not tell you that directly, right? Because their business is to lend you money. They're after their own interests, and as such, they hope to lend you money. But if they can't, they'll just tell you, hey, we can't, here's why. And they won't necessarily put you in touch with the right people that will. At least with an impartial third party, they'll look at it and say, hey, well, here's the likely lender scenario you're looking at. Here's the likely structure. And we'll shoot it out to a variety of parties so you can get a little bit more efficient when it comes to running a little bit of process on finding the right home from a capital standpoint.
Very cool. So if they want to talk to you, how do we reach you? Here we go, Matt, putting you on the spot again.
Yeah.
How do we get in touch with you? DGP Capital.
Yeah. Hit us up on our website, or even better, you can just email me. Feel free to reach out to Corey and team.
Or what's your email? Let's see if Matt, how fast Matt's fingers are. See if he can get it up here.
Sure. It's Jack Chang at dgpcapital.com.
Let's see. You're on the clock, Matt. See if he's paying attention.
With an A. Sorry,
it's an A.
There we go.
Come on, Matt. Let's go. No, it's Jack Chang, Change, or Ange.
Almost. Third time's a charm.
You'll get it. Well,
Third time's a charm.
there it is. All right.
There it is. Sweet. Thank you, man.
Awesome. Thanks, man. This has been great. I've learned a ton from it, and I think people will find the information valuable. And I appreciate you taking the time to come and chat with us today.
No, likewise. I enjoyed it and love talking about it. So yeah, appreciate the time.
That's pretty evident. You love talking about this stuff.
Yeah. Thank you.
Yeah. Thanks, man. We'll see you soon.
All right. See y'all.
Great. Thanks, Jack. Awesome. That's a lot of information. Jack's a smart guy, and I'm pretty grateful and thankful that he took time out of his busy calendar. I know how busy he is to come and join us. So if you are a small business owner and you're looking for some alternate funding, hit Jack up, dgpcapital.com. Otherwise, if you're a small business owner and you're struggling with your talent strategy or acquiring the right people, hit me up at keyhire.solutions. You can follow us. We have a free consultation, no weirdness, no sales. Just give us a call. We'll walk you through your talent strategy. Happy to do that. We love doing that. We can do that. We have our podcasts on all the major providers: Spotify, Apple, Amazon, Google, Audible. We're all over the place. Check us out on the podcast. Subscribe or follow us. Get on the YouTube channel. Subscribe to the YouTube channel. All this content's going up twice a month, and we don't want to make sure you don't miss out on it. You can also hit us up on our LinkedIn page. We are everywhere, and we would love for you to follow us on those social media platforms. So until next, we'll see you guys in 2 weeks. We'll see you at the beginning of March. Stop grinding, start growing. We'll talk to you soon.